The fixed mortgage cliff. Are we in for a massive housing downturn and a massive recession in 2023? In this video, I'll take us through 6 charts to tell you what is likely to happen to property, what is likely to happen to the global and local economy. If you're interested, carry on watching. My name's PK and I help people build passive income through the Property Investment Accelerator using data without needing a 15,000 buyer's agent every single time. And in this channel, we talk about property, the economy, and financial happiness. Give it a like if you think it warrants it. Let's go. Australia, fixed versus variable home lending. Okay, so everyone knows that as interest rate rumors started to go up at the start of this year, and last year as well, that fixed rates, or the number of people that put their home loans on fixed rates, dramatically went up. In fact, you can see it actually started all the way in 2020 because interest rates were so low, they could only go one way. So people thought, let me lock this in for a year, 2 years, or whatever the case may be. Now, everyone's worried about this fixed rate cliff where everyone who was on a fixed rate somewhere between 6 and 12 months from now, second quarter calendar year to about the third or fourth quarter calendar year next year, 2023, everyone's worried about all those people who they were paying 1.5%, well, let's say 2%, 2.5%, 3% fixed mortgage interest rate. Now they're going to start having to pay 5%, 6%. That will cause the property market to crash. That is everyone's worry. Now, let me say 2 things. And I've got other charts to talk about as well, talk about the recession, so stick with me. First one here is that basically since the end of last year, this trend started to reverse itself. So even before interest rates started rising, the fixed component started to come down, variable started to go up. Okay, so it's not as bad as everyone thinks. It's not like people in droves got fixed loan in like May or April or February, of this year. They kind of preempted that. Now that's the first. And second thing, and this is a very hotly contested point, I argue that even though fixed rate people or percentage went way up, the number of people who took fixed rates, you can see that variable was always higher. It was up at 80%. Granted, it came down, but the lowest point was still above 50%. So everyone who thinks that because fixed rates will come over to variable mid to end of next year, 2023, we need to wait and we need to see how much impact that will have on the property market. We need to assess whether that will cause the property market to crash. The reality is that same order of magnitude, 50% plus people have already experienced that, because those who are on variable rates, they were at 2%, 3%, and now they're at 5%, 6% with their banks, or even in some cases more. They've been able to withstand it. How do we know that? It's because the data tells us that mortgage arrears and defaults and foreclosures, to use a US term, haven't actually increased. So if that's a lead indicator of how those who are on fixed loans will react, then that's a really positive sign. Those who are on variable have been able to stomach it. Those who are on fixed will also be able to stomach it, provided they have time to prepare. And that's exactly what they have, because they're watching videos like this. Now, the second chart is for all of you doomsdayers out there. You can see Australian housing bubble warning indicator. What this shows is since the 70s, the real residential price index, okay? And it's got like a green bar to show the index, and it's got this pink range to kind of show where the standard deviation is, +1 and minus standard deviation band, okay? And so for those of you who don't know statistics, it basically gives a rough estimate of like kind of the caps. When you're driving down a highway and you kind of fall asleep or you get distracted and you hit that do-do-do-do-do and you pull your car back into line, that is effectively what standard deviation is in this chart. When the green line approaches the edges of the standard deviation range, or the edges of this pink shady bit, that kind of suggests that it's either overcooked or underdone. So for example, here in the late 80s, it was underdone, then massive boom, and then it was kind of tracking the standard deviation, and then it overdid it here just before the GFC, and it came down over here as well post 2010, and then it did that again around 2017, and then it's done it. This data is actually about 6 to 8 months old. So this green line is about 6 to 8 months old. So you can see the housing market, according to this term bubble, was in a bubble. I would disagree with the terminology, but it was definitely overcooked. You know, everyone knew that. It couldn't carry on like that forever, like 20% growth every single year. So it's got some time, it got some ways to come down. If you look at this chart as of updated today, it's actually back within that pink standard deviation range, okay? So it's not like it's got a whole lot more to fall. And in most cases, it doesn't fall well below that pink range. So it goes up, it stays within the range, goes up, stays within the range, goes up, stays within it, goes up just at the edge of the range. Here, because of APRA, they killed the property market, an artificial government intervention. It went below the range. I reckon it's going to go up, come down. Sydney's already dropped by 10%. Melbourne's almost dropped by 7%. I reckon the national property market is going to drop by between around 5 and 10%, maybe a little bit more. Sydney up to 20%, Melbourne up to 15%. But meanwhile, places like Perth, regional Queensland, other places will continue to go up because in the national property market, there's markets for the markets. But overall, definitely there's more downside risk in property than upside risk if you put a blindfold on and you don't know what you're doing. Of course, there's always markets for the markets. And if you look at this chart for Perth, you know, this green line will be actually below the pink line. And you'd say, oh, there's massive upside potential in a place like Perth. Now, I promised you that we'd talk about recession as well, right? I just want to really educate everyone, including myself, about the relationship between interest rates and unemployment. Everyone's like, oh, interest rates have gone up. How come everyone's still rich? How come there's no one getting laid off? How come, you know, we're having to continue to lift interest rates even though they've already been lifted so much? Like, when will the effect, the symptoms of a slowing economy actually kick in? What you'll see from this chart is that inflation led to high unemployment rates, but always with a delay. So in this example, inflation goes up and then unemployment actually takes 2.5 years almost to actually follow suit. Here, the red line, which is unemployment, also lags inflation. Inflation goes up and unemployment goes up, but it takes a year to catch up. Same here, it takes 2.5 years. Inflation goes up, interest rates go up, all the rest of it, but unemployment takes longer, in this case 2.5 years, to actually follow suit. So what's the point of all this? My hypothesis, which I've been talking about for ages, is that interest rates have almost peaked. Okay, interest rates have almost peaked. Inflation is starting to come down. If we continue to rise interest rates, especially here in Australia, that will lead to a massive, massive recession in maybe not next year, but the following year, because there's a lag effect. The Australian government, hopefully the RBA, know this lag. I'm sure they do, right? And so therefore, even though inflation isn't tamed, there is no need to continue to raise interest rates because the effect will come. It's just delayed. We just have to be patient. But there's no doubt that the global growth barometer is weak. This is from Drummond Capital Partners, and it shows the global growth, okay, global growth as a percentage over the long term. So we had the GFC in 2008, 2009, growth tanked, and then you kind of had it shady going up and down. A lot of volatile period around this kind of European sovereign debt crisis, Greece and Italy, other people almost going bankrupt, in fact, going bankrupt. And then you got the trade war. COVID took, you know, everything's locked down. GDP went all the way down, and huge stimulus came all the way up. And now we're trending downwards because interest rates are going up, and that's obviously starting to weigh on the global economy. Now, Australia's different. Australia would not be going down, but I fully expect, for the record, most countries, most developed nations across the world to go into a recession. I'm talking the US, potentially Canada, UK, European countries, maybe even New Zealand close to home, to go into a recession. I still, for the record, believe that Australia won't go into a recession, and we'll talk about that more as well. One reason is that Australia imports inflation. Okay, we import goods and services, so when those goods and services price rises, we import that additional price. US inflation leading indicators, you got the CPI leading indicator, 3 to 6 month lead, and the US CPI year on year on the right hand side. Both of these numbers suggest that inflation is being tamed. It's already tamed. You know, it's like you don't need to keep driving the car against the wall before figuring out the airbags work or don't work. It's like they've already popped. They've already gone up. You don't need to continue driving the car against the wall. There's no need for further interest rate rises in a huge order of magnitude because inflation is already tamed. It just takes time to come down. It takes time to transmit and to manifest in everyday life, just like unemployment. And so to cap it off, here's the interest rate expectations. Okay, so for the European Central Bank, currently the interest rate is just over 1%. The December 2023 forecast is almost 3%. Household debt to GDP as a ratio, very interesting ratio, and stick with me, this is a very important point, is actually remarkably low. So, all right, so what that means is that they have to raise interest rates a lot for it to impact households because debt is low. Compare that to the RBA. Our green dot household debt to GDP is massive. It's actually the second highest in the entire world. So we don't need huge interest rate rises for that to start having an effect on purse strings, on your back pocket for households. Okay, so right now the interest rate is around 3%. This is, I think, a month old, this chart. In December 2023, the anticipation, this is consensus, by the way, is just over 3% as well. So not too much more, 1 or 2 rate rises max. And the household is very high. So you can see each economy is different. The higher the green dot, the less they have to raise interest rates to actually have an impact. And you can see that as really well illustrated in the Federal Reserve. This is the US. They need to do a lot because household debt is actually not that much compared to GDP. Okay, so that's why, once again, I think in Australia, we'll need to do the least in terms of interest rate rises to tame inflation. Inflation is already being tamed. We're starting to import less and less of it from overseas. And by and large, yes, global economies are going into a recession, but we're entirely different. And I don't feel that the fixed income or the fixed rate cliff, you know, the fixed rates going on to variable is going to be as much of a huge issue as people think. Just like JobSeeker, just like JobKeeper, there was 100 different cliffs that people anticipated. Property market will crash. It never did. There's always things that can mitigate it, and we've already seen variable rates go up, and those on variable rates not really missing any household payments. Okay, what do you think? I'll keep your comments below. Hit the subscribe button, turn notification bell on. Let me know if this was valuable, guys. And always, the most important real estate is the 6 inches between your 2 ears. So invest in that first. I'll leave links below to my podcast on Spotify and Apple, Google Podcasts, and also to the Facebook group where all the 25,000 people. Level up your knowledge, because the smart money is investing right now, but not with a blindfold on. Definitely not in the Australian property market. Only in specific streets, only in specific suburbs, specific towns, or specific LGAs, local government areas. Gone are the boom days. By and large, you need to be prescriptive. You can make a bunch of money in the next 12 months. You just need to know how, obviously. Catch you later, guys.